Good afternoon. How are you doing?
I'm very well. It's a busy day today in the UK, isn't it?
It's been building up, and it was bound to happen. It's
It
just a
was
question of
bound.
when, isn't it?
Yeah, for the audience, in case you're watching this in the 20 years in the future, it's the 7th of July, 2022, and the Prime Minister has resigned um, after many attempts to avoid that fate. He has finally succumbed. So it's an interesting day today for us here in the UK. Yes. So David, great to have this opportunity to sit down with you and introduce both Halo Financial and for myself to give you and the audience a little bit of information about Lendai and how we come into the picture with regards to our financing and loan programs. And I hope today we can have a fruitful conversation that can hopefully enlighten our audience and our network and community about the best way to combat certain risks within the market, how to mitigate against certain investments that they're hoping to pursue, and also in this sort of climate, what is available to them. So hopefully we can cover some of those things, bearing in mind both of our company's products and what we do. So yes, I'm looking forward to this conversation.
Yes, so am I. I mean, as you say, the events of today, if people are watching in the near future, will highlight really some of the things that Halo Financial works on and works with and assists with. So it'll be a really interesting conversation. It strikes me the logical place to start, if I'm not usurping your intro, would be to talk about Lendai and actually what you do and what your product is and how it works.
Yes, absolutely. Yeah, I think that's a good place to start. So Lendai is a fintech platform allowing US real estate investors who are foreign nationals to borrow money against their US real estate investments. So that means anyone who is not living and a US resident, living abroad, but would like to invest in US property, they are still able to obtain a mortgage or a loan on their property and their investments in the United States. So for example, David, if you living in the UK are looking to buy a property somewhere in the United States to then use as a rental, you qualify here in the UK as a qualified borrower. However, it's a challenge to obtain investment in the US for a number of reasons. Then you would come to Lendai, we would qualify you, we would underwrite you based on the criteria here in the UK and certain factors that we can hopefully cover during our chat, and qualify you for a loan to buy US investment property. That's what we do. I head up the UK and Europe. We work with British investors, European investors who either already own property in the US and want to refinance their properties or buy that second, third, fourth, etc. Property to increase their portfolio. We work with them to establish loan programs that are most relevant to them and their financial position.
Yes. And in terms of the investors that would come to you, presumably there's a criteria for the amount of deposit they need to have available and the amount, a limit on the amount of loan to value that would be available. How does that work?
Yes, certainly. So our loan programs are really designed to have a nice balance between giving as much leeway for the investors to utilize their finance, their cash, their equity in the best way possible to diversify in more than one asset, but also ensuring that there's enough, so to speak, skin in the game with the investor themselves. So the typical and the average investment or LTV that we're looking at is around 70%. And that would mean 70% of the purchase price or the appraised value, the lower of, when it comes to a new purchase. What that would, of course, require is that the borrower themselves have 30% to put down towards the property for the deposit. And certainly there are some other costs involved, such as closing costs. And we like to see some balance, some liquidity available for maintenance of some monthly payments. That is sort of the highlight of what we require. Of course, there are some nuances there. We have a few more products such as the refinance, cash out loan program, whereby the LTV would be slightly lower, which would be approximately 60% of the value of the property. But yes, that's the range, and that's the sort of starting point where we begin the conversation. And when, in those who are really looking to get started in their US investment journey, that's the sort of range they should have in mind when they're looking at either the size of the property, the area where they're looking to purchase. It would depend how much liquidity they have, and we would build on top of that to enable them to buy their investment property. So that's the sort of nice sweet spot that we look at. But of course, as the conversation goes, we discuss certain criteria that the borrower has in mind, their investment journey so far. There are a number of variables that go into the analysis and the decision that we make. And again, different investors with different means can look at different states, different territories to have investment properties based on their affordability. Also, it's very much dependent on what they as investors, what their vision is. What are they trying to achieve? Is it a long-term investment strategy? Is it a rent to retirement sort of strategy? Those are the sort of conversations we would have with the investor to better understand what they're hoping to achieve, and we would sort of build with them the right loan program that can suit their needs.
So in effect, somebody who, because it is only investment products or properties that you're dealing with, specifically. So investors placing a deposit and funding the rest of the value of the property are effectively leveraging their investment. What are the upsides and benefits of that?
Exactly. So leveraging their investment, it can be one of two things. Either they've already got the property, they've owned it, entirely cash. Actually, I saw a statistic very recently that in the United States, 82% of British investors, the British real estate investors in the United States, hold their property or own their property cash outright. That means there's no financing involved. So that's a huge, it's a large market, of course, for British, for us as lenders. And really it's important to have that conversation and highlight the benefits. Certainly for some investors, they want, if they're in a retirement phase and they want to live in the property eventually and they want to not have any income, that's one consideration. But if you're certainly at the beginning of your journey where you're building up to that stage, or you're just using it as a rental property, it allows you, by leveraging it, allows you, to diversify your risk, which would mean you can put perhaps 30% of your cash in that one property and use the remainder of your funds to buy that second, third, fourth property. Or alternatively, you can use those funds that you were going to tie up into one investment into multiple investments. Perhaps you want to invest it in the market, in bonds, in whatever it might be. That allows you to diversify your portfolio as an investor and reduce your risk. That's the first benefit of leveraging. The second benefit is enables you to obtain higher cash on cash returns. What I mean by that is if you have a property with a 20 or 30% equity exposure, the return on that investment on your cash would be higher if you had multiple properties versus having all your equity and all your cash invested in that one property. Now, that's a huge benefit to investors who are looking to, again, diversify their risk, increase their returns, and build their wealth long term. That's one of the key benefits of leveraging. There are, of course, a number of other benefits that are hugely important to investors to consider. For example, there are certain costs that are deductible from their taxes, loan costs. That reduces their tax burden as investors, because of course any rental income that they earn, they have to pay taxes on that. If they can deduct certain expenses that are related to their financing costs, that can reduce their tax burden. And it's very important to note that, we'll touch upon this, I'm sure, in our conversation, that in the US, unlike the UK, there are more charges and more costs that can be deducted from their taxes. Whereas I believe in the UK, it's only the interest on the debt. In the US, there are other costs and other expenses that can be added to that. We'll talk about depreciation that can be deducted. If you're purchasing discount points, which would mean a cost to reduce your interest rate, that is deductible from your loan, from your tax burden. All these sort of benefits add to for the investor, it adds the benefit to, of course, leverage their property. Again, it's a conversation that we would have with each investor to understand what their expectations are, what their journey, what their hope is to achieve, what they're trying to achieve with this loan program, and we would work off of that.
So the taxation variations, or the deductibles, is one variation in the difference between the UK and the US property markets. Are there any other major differences between the two?
Yeah, I mean, there are many differences between the US and UK, and there are some pros and cons in each market, certainly. From the conversations I've gleaned from our investors, there are a number of benefits. I've talked about, of course, the deductions that you highlighted as well. There are things like, for example, the product that we offer, a loan program, which is a 30-year fixed mortgage. It is unheard of here in the UK. And what that would mean is that you, as a lender, we would fix the cost of the interest over a period of 30 years. In the UK, we're used to 3, 4, 5 years fixed, and then it turns into variable, or you have to refinance. What can happen is, as an investor, you don't have any certainty in the future of where the markets might be. It might be in your favor, it might not. The certainty of what the mortgage and the interest and principal expenses are going to be month per month allow the investor at the point where they're purchasing the property to calculate if this is a good investment. So long as today it's a good investment for them in terms of their costs and their expenses, and they can fix that so that they know in the future the likelihood of rents going down can happen, but we've not seen that in the past few years.
No.
This way they can fix their costs and their income going forward. That security and hedging that position for them is hugely valuable. That's something we don't have in the UK. I mentioned, of course, it depends where investors are looking to invest, but the fact that the United States is such a large country, it allows investors to really pick and choose what works, what they're trying to achieve and what works for them in terms of what states they want to invest in, what cities, what counties. For example, the UK market is very, very interested in investing in Florida, around Orlando area in particular. This is, driven by Disney, of course. It's a huge attraction for families looking to, spend their summer holidays entertaining their kids, grandparents joining their children and their grandchildren on the trips. It's a huge attraction. But there are other investors looking for different things. Some want to invest near national parks, for example, or cities that are really up and coming. There's such a huge variety that the UK perhaps we don't have, where we're limited. Certainly around London metropolitan, we're limited in where we can build. There's a lack of supply of properties, and therefore it really limits investors' ability to pick what they can invest in. There are other things such as the cost of living in the UK, or the cost of per square foot, the house costs. In the US, again, such a large variety of places you could choose from. And even comparing the UK, London, prime market, residential market versus other metropolitan cities in the US, the cost of house prices is significantly lower. I believe it was $27,000 per square foot, if I'm not mistaken, versus, for example, in San Jose, California, it's around $9,000 per square meter. So we're talking about huge differences, huge benefits. I mentioned the taxes, I mentioned the loan programs, the variety, the attraction, the amount of tourists that it attracts if you're looking to do short-term rentals, for example. We have a huge domestic market as well as an international market. Therefore, all these considerations make the US a really attractive place for investors to buy property. Otherwise, we wouldn't be around if it wasn't such a popular destination, of course. But yeah, the variety and just the huge size of America creates a huge opportunity for investors. And at
Yeah.
least it gives them the ability to make decisions and choices that meet their financial goals. Yeah.
I mean, I'm intrigued by that 30-year fixed rate, because that strikes me as a no-brainer at the time when the Federal Reserve is very hawkish about where it's going to push US interest rates. Current rates must be a very attractive option for investors.
Yes, certainly. I mean, we're in an environment of increasing uncertainty, and it doesn't seem to abate anytime soon. I mean, every week we have conversations with investors who are hoping things will improve or stabilize, and they keep pushing off perhaps making that decision and fixing their interest rate or fixing their currency rate. You know, we can certainly talk about that too. But in this environment of huge uncertainty, where nobody necessarily believes it will be much improved in 2, 3, 4 years, the importance of locking in your rates today to ensure that you're not, missing an opportunity to secure a lower rate than eventually what would come about, is hugely important. Now, again, our mortgages are 30-year fixed, certainly, but it doesn't necessarily mean that in the future, if rates improve, for example, in 4 to 5 years, that you can't refinance and benefit from that environment too. But in the short term, in the next 2 to 3 years, the likelihood of that being such a huge difference, according to what I'm hearing and what I'm reading, and I'm certainly not alone in that, there doesn't seem to be any indication that it will be that much lower than where we are today. So when we talk to investors who are quite nervous and rattled by the direction and the conversations that are happening with the Federal Reserve, Bank of England, whoever it might be, that interest rates are going to rise, or there's some uncertainty, perhaps they won't rise, perhaps things will stabilize, I don't want to finance today, perhaps I'll wait another month or another 6 months. I've been having these conversations for the past 6 months, and look where we are. The rates 6 months ago versus today have gone up, have almost doubled. So it's never a good idea to leave things for tomorrow. If the investment makes sense, this is what we hear a lot from our investors. If the investment makes sense today, with the current rates, with the rates of return that they can obtain, then there's no reason not to secure the interest rate today, not to secure their currency rate today, and whatever might happen, even if it improves, great. Then when it comes to it, we can reassess. So, I mean, this leads me really to having a conversation with you about the interest rate. I think this is a nice segue to discuss the uncertainty that you're seeing from your end. Of course, I've addressed the interest rate uncertainty, but there's of course a correlation there. What are the impacts are you seeing in the market with the current levels of inflation and political uncertainty? What are you seeing in terms of both the US dollar, because of course we're talking about US investments, but just the rates in general?
Well, it's there's never a quiet time in foreign exchange, which is one of the reasons we set our business up 18 years ago, and no 2 days have been the same in the whole time. So it's never a quiet time, but at the moment it's ludicrously busy with so many external factors, because it isn't just about the UK and the US and UK and US interest rates. Events in Ukraine, the effect of Russian sanctions, the fact that Russia may be turning off energy supplies to Europe, all of those have an impact on the investor sentiment around the world. And you'll know all about that in your market, but investor sentiment drives foreign exchange rates. Nervous investors will tend to buy US dollars because it's the most liquid currency in the world. It's a safe haven from all the woes of mankind. So nervous investors will tend to buy into the US dollar, maybe into US treasuries as well, to do something useful and get a yield from that money. And so right at the moment, the dollar index is the strongest it's been for 20 years. The sterling US dollar rate is the lowest it's been since the mid-1980s. And all of that is driven by events outside the US to a large degree. But the fact that the Federal Reserve, having had almost zero interest rates, as most countries have for the last decade or so, and now starting to raise their interest rates to try and normalize the level so that there is there is a return for investors on deposited funds, but where there hasn't been for such a long time. But also to try and control rampant inflation, which is being driven by the massive rise in energy prices in particular. And so they are in a bit of a quandary, because if investors are being stretched by the rise in inflation, which is running at ridiculous levels everywhere, then raising interest rates just stretches consumers even further. So it's a very difficult balance to strike for a central bank. So the Federal Reserve has made it fairly clear. Jerome Powell has led the charge on this, that interest rates in the US will be rising, and quite substantially so, over the next year. Whether that carries on into a sustained period of rising interest rates is the big question mark. Part of the reason I was so interested in a 30-year fixed interest mortgage, because it's almost impossible that US interest rates will get down to the levels they were at last year unless something very dramatic happens, and that would, I'm not quite sure what that would need to be, but it would be a big catalyst of some
An
sort.
act of God of sorts.
Yeah, or even greater, who knows?
Or even greater than God, certainly, from what we've seen and from what history suggests, yes. And again, it's really important to really hone in that message that we are in a different environment. I think everyone got a bit drunk on cheap money, on cheap interest rates, and perhaps a bit more stable markets, and they've forgotten what inflation used to be like, or what interest rates used to be like before the past 10, 12 years. And we've gotten a bit complacent, and it scares off a lot of investors. However, those that are savvy enough to realize that there's never a better time than today to make financial decisions to secure their future. That whatever, as again, I keep repeating this, if the deal makes sense today for more than one reason, not just with regards to the financing that they are able to obtain, but also the returns of the exchange rate, and that if they have enough for the down payment, the future is not necessarily going to be brighter in the very near future. And again, in the longer run, they have more flexibility in terms of what they can do to readjust their position. So talking about interest rates. So we talked a little bit about of course, the interest rates, how they impact the foreign currency markets. We talked about political uncertainty. There are a lot of these risks that really can impact a first-time buyer. And my concern for my clients is they start the conversations with us really eager, they have some liquidity, they want to start their journey investing. What would be the best way for them to secure and ensure that their funds that they currently have for their down payment on a property they have in mind that they wish to buy, it still remains the right amount when it comes to closing? Because as you're probably familiar, there's a time lag there. What can you help? How can you help us understand what the best strategy and the best way to avoid any surprises down the line?
Well, there are a number of things that people can do. One of the things that we do with our clients is our first conversations are all about trying to understand what their situation is, because as you very well know, every client is slightly different, their circumstances are different, the availability of liquid funds is slightly different. So we need to understand all of those things in order to be able to provide the service that we do, the information that we do. The key, I guess, really is early planning. And for a lot of people who are looking to invest overseas, if it's their first time, I would hope they've done a lot of planning and a lot of reading and a lot of talking to people who know more about those things than they do. But if you plan early and you know that you have, I don't know, £60,000 that you need to convert into dollars in order to put the deposit down on the property that you need to buy, then there are a number of things to do. If the client has a US dollar account, then of course they can convert the funds whenever they wish and then hold them in US dollars in order to fund the deposit for the investment. And with interest rates as they are, they'll probably get a better yield out of a deposit account in US dollars at the moment than they would in sterling. So there's sort of a double bonus. If they don't have a US dollar account, and presumably they will need one at some stage if they're going to be receiving rental for their property, and therefore will need to have that paid somewhere. So if they do have a US dollar account, they can put money straight into it. If they don't, then they can still purchase the currency on a forward contract for a date when that account is in place, and then they can move the money across. And a forward contract is effectively agreeing an exchange rate today, but agreeing a settlement date for that contract at a date in the future. And that could be up to 2 years in the future, depending on the necessity. And the neat part about that is that in order to book a forward contract, they only need to pay a 10% deposit of that amount. So they keep the rest of their funds liquid until the date that they need to actually pay for the balance of the contract. So from an investor perspective, keeping your funds liquid so that you can actually deposit them somewhere or do something useful with them is obviously a big attraction to that.
Oh, that's excellent. Do they need to have, I would love to learn more about this. Do they need to have the remainder of the 90%? Obviously, 10% is for the deposit, but the 90% left, does it need to be in cash, or can it be invested in any other financial product?
No, it doesn't. The only time it needs to be liquid is for the settlement date of the contract. So if we agreed a contract to buy £60,000 worth of dollars for a year forward, let's say, then we would just need 6,000 to secure the contract, and then the other 54,000 would need to be available and liquid for the date in a year's time to settle the contract. It is a little bit, it's a bit more flexible than that. Sorry, talking over you, but it is a bit more flexible than that. Although we set the date for a year's time, let's say, if the property becomes available sooner, then it is possible to draw the contract down for earlier settlement. And if there's a delay with the build or documents or whatever, then it can be extended out to a slightly later delivery date. But as long as there's a property in place that's being built or will be available, then we can put that contract in place.
That's really valuable, because the first thought that comes to mind is, as we're familiar in the UK, the long time it takes to actually close on a sale. So, for example, we have instances where our investors are selling a second home or an investment property here in the UK, and there's that time lag because, of course, there's a chain. But they want to ensure that they have an interest rate fixed for the time at closing that they need, but they don't want to, have, they're not able to sell the property and receive their funding before a certain date. So that's the first instance where I think this can be hugely valuable. And of course, you mentioned if they have the remainder of the funds in an investment product that's yielding a good return for them in their original currency in GBP in the UK, then perhaps they don't want to rush with a conversion, or they can't, perhaps they've committed to a certain time frame of investing their funds. So that's a good product for them to explore. So that's very interesting.
It's an element of tidying up loose ends, isn't it? Because the more variables there are with any investment, the more complex it becomes. But if you can tick off, yes, I've got the currency sorted, and yes, the rest of the balance is in X investment here, and yes, I've got the fixed term mortgage sorted. If you can tick those things off, then the whole process becomes a lot more manageable, I think.
Yeah, absolutely. And shifting gears a little bit, I mean, we're talking a lot about purchasing property, first-time buyers. What about those that perhaps already own a property in the US? Can you also help those that are looking to sell, those that have some income in USD, want to repatriate their funds back to the UK? Perhaps they have a project here that they're looking to work on. Because, of course, we do, as I mentioned to you, we do cash outs and refinance, which was equity release in the UK. And there are many instances where it works the other way around. We want to bring back the funds to the UK. So how can Halo help in that front?
And it's often a case that an international investor will have investments not just in the UK or the US, but also maybe in Australia and maybe across Europe or wherever. So we handle a lot of clients who are moving funds between different investment pots from time to time. And we have client accounts in 76 currencies, I think, last count. And so we can handle transactions between any two of those, so the permutations are endless. But somebody who's looking to move monies back from, let's say, a property sale in the US, is looking to move that money back to the UK. The process is very much the same. If they've got sterling accounts already set up and the exchange rate is attractive to them at that moment, then we can book what's called a spot contract. So you trade on the spot for settlement within up to 5 working days. If their funds will be coming available in a month's time, but they really like the exchange rate, again, they can take advantage of a forward contract and set the rate and book a settlement date in the future. So that's available to them. But there's also if you're invested in property in the US and you're receiving rental income from those, which you want to repatriate on a monthly basis, we have a product called a regular currency transfer, which is set up on a standing order basis, so that you can agree an exchange rate that will cover the next 24 months of payments, and much like your fixed rate mortgage, that sets an absolute level for funds returning to the UK, and obviously then your yield is secure in the currency that you need it to be in. So that's an option a lot of people use, and maybe not because there will always be some maintenance costs and living costs and what have you in the US perhaps. If they've got a £5,000 a month coming, $5,000 a month coming in, maybe they'll set that for 4,000 and then do an annual top up just to clear the rest of the balance. So there are ways and means that people manage it, and again, it comes down to their circumstances and what local costs they've got as well.
So that's really neat, because an investor can really hedge their position, especially if they're the more conservative ones or the ones that have got obligations that they need to meet. Yes. Or they want just the clarity of mind and the peace of mind to ensure that all their expected income and expenses are really secure and frequent and regular. We have the fixed interest rate, so we secure their fixed principal and interest payment per month. They can set up what you mentioned, the contract that allows them to have those regular regular interest rate for their income in the US, and thereby they've covered really all corners. I mean, it comes back to sort of taking uncertainty out of the investment, doesn't it? So if it can work also where we have some clients who have a regular income in the UK that they bring to themselves overseas, and or a pension or what have you that they bring to themselves overseas on a regular basis. So dependent on the the demographic of your clients, if they're looking to take an income from the property they're renting, then that income might be their living expenses. So therefore, it does make sense for them to bring that back on a regular basis. Yes, certainly. I mean, because especially, some of our investors, they've bought properties, a few years back now, and the rental income has significantly risen. So they're left each month after all their expenses, their mortgage payments, their taxes, their insurance, all those, that good stuff. They're left with a nice surplus, whether it's on a quarterly basis or a monthly basis, even annual, that they want to repatriate back to the UK. Either they don't have any intention to purchase a second property, so there's no need to accumulate a fund there, or they have use for it here back at home. That's certainly something that we see quite a bit of, and having that rate secured for them, especially nowadays with US dollars. I mean, it's almost parity with the euro. Are you already at parity today? I mean, I haven't followed.
No, not quite. It's very close. I think 101 something last time I looked. Yeah, 101.70. So it is, and everybody is expecting it to happen, just purely because there's nothing particularly supporting the euro. So I think parity there, but there's also a lot of talk about how low sterling US could go, because whilst we will have a change of government, it doesn't really alter the situation with the UK's debt and trade balance figures, which are not attractive at all. So there's a good chance sterling will weaken, which then makes sense of somebody looking to cover themselves forward on a forward contract if they've got the right investment with the right property and they can secure the right mortgage for the balance, it makes sense to tidy that up. Even though the rates are not attractive in historical terms, they may well be quite attractive if you look back in 6 months' time. So
yeah, I mean, we both recall the 2-for-1, right?
yeah,
$2 for a pound, and we thought that was the environment we're going to see ourselves in. And when the rates declined or adjusted to the closer to the levels we're seeing now, we always expected, perhaps things will improve, but we both can obviously see that that's not the case. So there's no reason to believe that there's going to be any improvement in sight in the near future. And
it's hard to see what the catalyst will be for that, unfortunately, in the very short term. There needs to be a lot of change, and we're still in the backwash from the Brexit exit. So, until those details are all worked out, sterling is always going to be under the cosh to some degree.
Yeah. I mean, just to elaborate a little bit more about the market, from our position, we're seeing, for example, there's been in Florida a huge increase in property prices in the past 2 to 3 years. And with all this uncertainty, the interest rates going up, so the cost of financing going up, and the exchange rate and everything else, inflation, cost of living crisis, gas prices, everyone is expecting a huge crash. But from just observing the fundamentals in the market, looking at start with the supply and demand of houses, just on that basis alone doesn't necessarily support the argument that the crash is imminent and it's going to be of the levels we've seen in 2007, 2008. The amount of equity that investors and homeowners have in their properties are at levels that are far more conservative than we've seen. I mean, there were in the US, I know as well in the UK, they were offering 105% on mortgages. LTV. That's nowhere near that these days. So, as I mentioned, the fundamentals are hugely improved and don't necessarily support the huge dip that some people in the market are hoping for. Certainly, there's a rebalance, I would say. I mean, our investors are finding it a lot better in terms of making offers on properties and perhaps being more successful at the bidding. It used to be that there would be 20 offers on any property listed in one day, perhaps now it's around 5 to 6. So it's more realistic that their bid will be accepted, which is good for investors. They don't, otherwise it would be driving up property prices to levels that are unrealistic. And as a lender, we were seeing it. Our appraisal reports were coming back with rates that were far higher than the actual, far lower than the purchase price. So things are balancing out. So that correction might be actually in favor for investors and might be to their benefit. Certainly not looking like the prices will go down significantly anytime soon. There are, again, costs of financing has gone up, cost of insurance in Florida has gone up. So definitely there's no time like the present to take that first step, as far as we can tell.
And that, I mean, the correction in the market, is probably an understatement of the 2007, 2008 correction in the property market. Surely that leaves the market in a better place than it was in terms of price levels and availability. So I can't imagine, even if there were a small correction this time around, that it would be anywhere near that sort of scale.
Yeah, exactly. That's what we're predicting. That's what we're seeing. That's what we're hearing. Also, things have changed, talk about the technology that has changed dramatically since then, and the availability of data and information. A lot of the stuff is already built in. There's a lot more knowledge that's disseminated a lot far quicker. There are communities and there are ways for people to sort of readjust their portfolio, readjust their position, or make smarter decisions. I mentioned there's a huge supply and demand issue, new housing that's not being built, and there's a huge time lag in those projects that are even under development with regards to the supply chain issues. So everything seems to point towards a crash that's nowhere near the levels of what we've seen in the past, 15 years ago.
I know the press like to call anything a crash rather than
Absolutely.
an adjustment, but yeah, I can't see crash in my terms in that
Yeah.
market.
I mean, I would hate to be proven wrong. Not that I want to crash, but
No,
it doesn't seem it's it drives a conversation, right? Having
yeah,
these doomsday expectations, and also
yeah,
there's some hope for better investment returns, right? Buying at the dip, but
yeah.
yeah, it's certainly from our perspective, all everyone is continuing their investment journey almost as normal, with some adjustments, of course. So yes.
We talked about you mentioned the 30-year fixed rate loan. Presumably there are other programs and other loan programs that are available to people. Do you want to talk about that?
So yes, so the loan programs that we offer are geared at a couple of types of investors. So I mean, the British market, which I will focus on because that's probably most of our audience, that's my audience certainly, and even the European one is quite mirrors it to some degree quite similarly,
Yeah,
whereby the traction or the investments that they specifically seem to like is the short-term rental investment property. And what that means is buying a house, renting it out week by week on Airbnb, VRBO, or property managers, more unique boutique property management firms that perhaps tailor the house to a more experienced, oriented stay. There are some houses that I've seen that are just spectacular. So it's more, I guess, niche markets. And for those types of investors, we have a loan program that's geared at short-term rentals. And that would mean, I mean, there are of course some differences between that sort of loan program and one which is for just, buying a property, renting it out for a year, and that's considered a long-term rental. That's perhaps more traditional. That's the traditional loan program that we have. This second one, short-term rental, is very specific to what I'd like to discuss today about the British market and European market, because what it allows us to do, it allows us to look at a property that's not expected to have a tenant in place. And that goes as well for the refinance. I mean, I'm speaking more on a new purchase front, but it's the same with the cash out with a refinance. It's okay if the property does not have a tenant in place because we rely on different data for that sort of product. The data that we rely upon, is the market or expected return on a similar property on a short-term basis. So we would obtain data either from the existing owner or the property manager or the realtor or publicly available information that can sort of gauge what the level of income would be on that property on an average, and we season that. So what would happen is we would obtain the 12 months expected income and we would average that out per month. So for perhaps, December, January are very busy months, July, August are hugely, financially rewarding months. We would average the income over the entire year so that we can calculate what the return would be. What this allows us to do is, of course, with managing a property that is turning around tenants on such a frequent basis, so week to week, there might be higher expenses. However, we can observe and obtain the information on the higher expected income over the course of the 12 months to mitigate against those higher costs when calculating the eligibility of the borrower. Because it's important to note that with investment properties, we look at the investment like a business, really. So what are the expected income? What are the expected expenses? It's very much a business, almost a business loan. So even though the costs are going to be greater for a short-term rental, we would mitigate that by obtaining the expected income on a short-term rental basis. So that's a really new product in the market, I would say. Many lenders are not yet there, certainly not with the foreign nationals, because it brings with it greater risk because there's no tenant in place, there's no lease. We are purely calculating it on expected income. So that means, perhaps they may even have some bookings in the pipeline, but most likely they don't. But we feel confident that in that specific zip code or, the comps with other properties in the area, that their realtor or their property manager knows and is familiar with can share with us information that can help us determine that rental income and secure the loan based on those figures. So that's a really unique product that's quite new to us. Actually, we've only it's been available only for the most recent months, and it's the same across the market because the market's really adjusting to the new trends. And this is something, again, perhaps in Florida they've been ahead of the game a little bit because of the nature of the tourists that it attracts, where people like to come with their family for extended periods, not be tied to one hotel room. They want to have a house, they want to have a pool, they want to have their own space, a kitchen. So they've been quite ahead of the curve, but there's been a huge lack of financing solutions for that sort of experience that investors have got the journey that they've taken on board. So that's the loan program that's quite new and most relevant to our market. But of course, we have the more traditional ones, which are the long-term tenant. You buy a property somewhere, you want to put a tenant in for 12 months, you already have a tenant in, that's fine. That's what we call a long-term rental. So those are the two programs. All our loans are 30-year fixed. It's the most popular product. Again, in the future, rates might change, the environment might be very different, and they may wish to refinance, and that's absolutely fine and available to them. But the certainty of the 30-year fix and the comfort it gives investors is hugely popular, and it allows them to have the flexibility to make any changes when conditions have materially changed, as I mentioned.
I'm going to ask you how long is a piece of string now, I know, but in terms of somebody coming to you, they've seen a property that they want to invest in and what have you, what's the time frame necessary to carry out those checks and get that data and make those assessments?
Yes, so that's an important part of the journey with our borrowers and our clients. I mean, generally speaking, there's a variety of investors, and there's a difference between where they are on the spectrum of starting their journey, their investment journey. I would start with looking at those who've watched this conversation and have been inspired to begin their journey, and perhaps they've thought about it previously. The first step is to get pre-approved with us. And what that would allow them to do is they would come to Lendai, I would have a conversation with them. We'd get them started with the application, which everything is, by the way, digital. Even the closing of the loan is digital. There's no need to come physically to any offices or be physically present in the US. The whole entire process is online and at the comfort of their home. Of course, they have a dedicated customer service representative if that's what they wish. But certainly they can, it's self-explanatory enough, the process, that they can do it themselves at their convenience. But as I was saying, what would happen is they would start with a pre-approval. We would qualify them based on their liquidity, based on their income level, based on their position back home. Do they already own their primary residence? Do they have other investment properties in the US? Do they have sufficient funds for a down payment? Of course, all those, that piece of the picture would be input into our credit scoring system. And based off of that, we'd be able to provide them with a pre-approval letter for a certain amount that they could qualify for to borrow with us. So the reason why we like to operate like that is because then they can go to their realtor in the United States and say, okay, I have such and such for the down payment. I've qualified for such an amount with Lendai. Please, can I now look for a property that meets that criteria? And this is the best way to do it, because also in most markets in the US and for most realtors in the US, they won't even work with a client that doesn't have that pre-approval letter. Our pre-approval letters are valid for 90 days, so long as nothing has materially changed within that time frame. So that is the best process. However, if there are people watching, or you speak to anyone who's already found a property and they want to make an offer on that, we can also start there, no problem. What we would do is we'd start a new purchase application. We would put the property address. Our algorithms would be able to obtain the expected property value and rental income and expenses through the system that we have built to capture all available and privately available data points. What that enables them to do is get a very realistic term sheet and pricing worksheet to understand what their expenses would be, what the down payment would need to be, what the loan amount would be, so that when it comes to closing, when it comes to the end of the process, the figures won't be too different. I would say 90% of the time, it's within 90% range of accuracy. So that's really beneficial that already from the get-go, they are, can be very realistic and a better understanding of what it's going to look like at the end of the process. So that's the best point of contact, or the best point to work with us, either, as I said, pre-approval to begin the journey and start looking for a property, or if they've already found a property and they wish to make an offer and they wish to explore financing with us, they can come to us at that point as well. Of course, there are those who are watching who already have 1 or 2 properties in the United States. Perhaps they want to refinance. Perhaps they own it all cash and they want to buy that second or third home, or they have some other use for the funds. As I mentioned, some like to bring it back home, make an investment here in the UK or elsewhere, of course. And perhaps they want to have a holiday once a year in Florida, once a year in Portugal. No reason to deny yourself. So either option, they can come to us at any point, and we will work with them. We will have a conversation with them, meet them over Zoom, and work with them to begin the journey and get the ball rolling.
Superb. I have to say, I'm comforted by the fact that there is that affordability check, which was not present before 2007, hence the problems in the market. But I mean, that's really interesting to know that you can step in at any stage of the process, depending on where somebody is with their property search.
Absolutely. And also, it's very important that before you work with a realtor, you understand what the expenses are going to be like, which is what our systems enable you to do.
Yeah.
Sometimes, especially the first-time investors, they're not perhaps aware of the differences in the market in the United States and what it would look like. For example, many investors aren't aware of the litigious society that America could be and how they need to mitigate against us. And our systems, for example, one of the things it captures is what the interest costs might be. So it's not interest, the insurance costs, apologies. Things like that perhaps with a lender, it gives you that other level of due diligence or another layer of due diligence on your investment transaction. Does this deal make sense? Because the likelihood is we as a lender, our business, we don't make money if we don't do a loan. If we are not so comfortable making an offer on a loan or an investor property, perhaps you might want to revisit your figures and see if that's a deal that makes sense. So even just for that, for the sake of that, it's very important to start that or to do that analysis and start the application with us.
From our point of view, if we're handling a client who is in that process of finding a property, getting the funding in place and all of those things, the more clarity they have over the eventual costs, upfront and ultimate costs, the more clarity they have, the better we can help them plan their foreign exchange needs within all of that. So that's really interesting to hear.
Yeah, and it also makes, it makes me think of Hanah and understanding better at what point does it make sense as well for clients to come to you and have those conversations. Is there a point in time that's the most valuable? Is there a suggestion that you have? Can you talk to us about how the process would work?
Yeah, so as early as possible is the simple answer to that question, because it may well be. Let me give you an example. We handle an awful lot of people who are migrating to Australia, New Zealand, South Africa, the Far East, and what have you. Sometimes the visa process for that can take 2 to 3 years to organise. But if we've spoken to somebody who is going through that 2 or 3 year process, then we'll know with them when would be a good time to start looking at getting some exchange rates booked or moving some money out there. But if we hear from them 2 days after they got their visa and 3 weeks before they're flying to Australia, it's all very last minute and the opportunity is gone to make the best out of the exchange rate. And I guess the same is true for somebody who's planning a property purchase. obviously some of those will go through very quickly in a matter of months rather than years. But if they're buying an off-plan property that's in the process of being built, for example, then making the plans as to how they're going to move their funds into US dollars and when that transaction is going to take place. That's the really important part of the process. So if we speak to people early in their thinking, hopefully we can enlighten them on some of the things that they should be thinking about, which they may not have done at that point. And hopefully also we can guide them as to when they should start thinking about moving money, because there's certainly the worst thing to do is to start booking exchange rates before you found the property, before you know whether you can get the funding for the rest of the purchase and all of those things, because otherwise you end up with a currency contract you don't need or may not need. And then you've got to sell it and there may be a loss and all of those things. So absolutely the time to be thinking and planning is right at the very early stages, but the time to be purchasing your currency would coincide with when you're making commitments, make payments. And so we can work with our clients on that basis. Okay. So again, excellent. Everybody's different.
Everybody is different, yes. And sometimes no matter the advice you give, people, have their own ideas of how they wish to do things. But absolutely. Listen, I'm sure you feel the same, but we do our best to accommodate everyone, whatever point of the journey that they find themselves in.
Absolutely.
From our perspective, we can move really quickly. That's the benefit of being an agile company. It's very tech oriented. Our closings within 30 days easily. We've done a couple, but not a couple. We've done quite a few that have taken a couple of weeks even. So we try and be as quick as possible and as available as possible as well. Now, in terms of I'm sure for some people perhaps who aren't as familiar with Halo because they've not had any need to until this point. Can you talk us, about the safety and security of doing transactions or sending funds?
Yeah, absolutely.
With Halo?
Absolutely.
So anything you can reassure our investors?
Yeah, of course. So we established Halo Financial in 2004. So we're sort of 18 years old now. Set up as a money services business with HMRC as it was at the time. That's all changed. Now the Financial Conduct Authority has put regulation in place to regulate payment services, which is fantastic because it sets some standards and the markets have to abide by, which is very good news. It slimmed the market immediately because there are lots of small companies that didn't have any kind of standards to operate with. But the key to being an authorized payment institution, as we are, is that the biggest part of that regulation is about how we handle client funds. We have to have a certain level of capital adequacy to prove that we're a sustainable business. We have to secure client funds in client accounts. If we're holding funds for a client overnight or for a number of days, then those have to be in what's known as a safeguarding account. So those are ring-fenced away from all other client funds. And that's an account that's recognized by our bankers as being safeguarded in that way, which is a regulatory requirement. And we have certain methodologies we have to use in order to do our due diligence on our clients before we trade with them, do the due diligence on the funds, where the funds are coming from and where the funds are going to, in order to make sure that our business doesn't get caught up in any kind of money laundering or bad actors. But from a client's point of view, the important thing is that the process is very straightforward. We act very much as a service industry. We put somebody within our business on our private client desk in contact with our clients so that they form a relationship. The consultant on our desk will then find out what the client's requirements are, qualify much as Lendai does. Qualify the client's requirements and their ability to transact, and then we make sure that we provide them with a flow of information that helps them make the right decisions. We don't decide for them, but we'll provide the information to help them make those decisions so that it fits within the parameters of what it is they're trying to achieve, and that they don't just get all excited and buy currency at the first moment and then live to regret it for some reason. So, but as I say, that with all the contracts that we set up, it's a contract for X amount of money to be exchanged for X delivery date. That's very flexible once it's set up, because if the client's circumstances change, then we can alter the contract to suit. And to a later date or a nearer date, dependent on their circumstances. And we will work with them to make sure that the funds arrive and depart and arrive the other end as promptly as possible through the SWIFT payment system, which is the standard international payment system. So in terms of security, we've been around a fair amount of time, and if anybody looks at our ratings on FIFO, we're a platinum award-winning company and have been for 5 years. So I think our client testimonials are all about the quality of service that people have received, and I have to say that makes me rather proud.
Of course, as it should do, and I'm glad we share that value, the customer experience and the customer journey. It's paramount, and certainly what I hope would set us apart. It makes all the difference, I'm sure.
Yeah,
so I really enjoyed this conversation, David. I hope.
Yeah, me too.
It's nice to use this opportunity to engage and share knowledge and share information. I'm sure that show links will have ways to contact each of us for our respective services. And I really appreciate the time and the insightful questions. And I hope to speak to you again in the future.
Thoroughly enjoyed it. Thank you, Hannah. I find that I learn something new every day, and I've learned quite a lot today. So that's been a good day.
Absolutely. I feel exactly the same. Thank you so much. And thank you to your team as well for all the wonderful things you do for our clients.
Pleasure.
Thank you. Take care.
Bye.